Here we are on actually open position over here on the Aussie dollar, a little bit of unrealized loss at the moment. And if I take a look on our history of trades as well, a little bit of drawdown pursuing for us, but still in realized profit at the moment in our 100K Traders Challenge account. We're going to be reviewing all of this in this video to see if the strategy is really working. How do we actually analyze this like a professional trader? What are the 3 key points we'll be looking at, and also on the 50K account? This and more in this live trading session video. Hi traders, thank you for joining the MasterTheMarkets team in our live trading session video today and supporting us in our mission to spread the truth of trading and help you achieve consistent trading performance. It is Sunil Upon here, founder of MasterTheMarkets, every trades conference and the Traders Open Day. So here we are, traders, on the Aussie dollar chart. So let me just pull up the Aussie dollar very quickly over here so that we all can take a look at very quickly. And what we have is, so as of yesterday, we did have a buy signal here on an uptrend phase 1, and that's where we took that trade on the Aussie dollar, and it's towards a phase 1, and the weekly was aligning as well, right? However, today we can see a big red outsider buy and took out the high and took out the low, pulling back a little bit up again. And that's what we got here on the account over here, which you can see a bit of unrealized loss at the moment, right? So that is the rationale. Now, of course, this is just volatility that we are looking to manage until our rules are set in place, then we can't exit the trade. Now, all this is explained on our channel. But today, what we wanted to do was actually take a look in terms of the overall review over here, because I know a lot of traders, when you're trading an account consistently, sometimes the biggest demotivation is, you got all these profits, now you're going through a drawdown, and then this lack of conviction starts to happen, right? You start to lose your confidence. You start to think, what, is this really working? Should I do it? Should I run after another strategy? And I know a lot of traders, hedge fund traders come to us as well, professional traders who've been trading for 10-15 years, and they all start, not understanding how to analyze their performance. They start running after the next shiny object, right? So how do we do this? Now, how do we stick to that strategy, knowing in conviction it's still sustainable, scalable, and reproducible? So today in this thing, I would like to share with you 3 key points, right, in performance review, all right? So let's take a look first. So now if I bring this up over here, let's bring this up over here on 20% OE. Now, the first thing that we always look at, traders, on our 3 key points in performance review, the first one, we always take a look at our maximum drawdown number, okay, our maximum drawdown number. Now, what do we mean by that? Now, let's go through that and let's break it down. In terms of our 20% OE figures, right, over here, so let me just bring that, scroll down a little bit down. You see, on our 20% OE strategy, which is on the 100K account, what we're doing over here, you can see that is about 2.89 maximum drawdown at the moment in the system, right? So we look at first, in the maximum drawdown, we take a look at the system maximum drawdown. After that, then we also take a look at our backtesting maximum drawdown, okay? So that is 3.80. So we haven't surpassed our backtesting maximum drawdown. So you must always have a reference point to where you should start considering to stop executing your strategy, or you start to doubt that, does this really have an edge? So that will be the first point, okay? Our backtesting drawdown. Not only that, traders, my mentor also used to tell me that he trades for big hedge funds, Morgan Stanley, Money, and Dubai and all of that, Saudi and all of that. And he used to tell me, Tiru, no matter how much backtesting you do, right, whatever drawdown number you get, usually times it by 2, okay, and expect that to be reached. Okay, so that's the leeway that we gave, okay, of your backtesting, times it by 2. So in this case, it's about minus 7.6%, okay, is what we are looking at in terms of our maximum drawdown. So once it hits that, then we should stop it and analyze it and review it before we get back to executing again. Then the next drawdown that you should be looking at in maximum drawdown is your cash drawdown. Okay, how is your cash account really doing? What's your maximum drawdown that you're having in that? In here is minus 2.64. We're actually beating the system because of some trades that we missed, which worked in our favor. Okay, so that's the 3 types of drawdowns that you would be looking at. And after you've got that, then you would have a curve like this, right, on the right hand side, where you got that, and then you can see how both of them are doing. Okay, right, so that's what you would do over here. Now that's on the 20% OE. Now on the 50% OE, however, as you can see on the 50k account that we are doing, right, we're running 2 types of strategies, right, which I'll explain in a minute, and why the drawdowns as such. On the 50% OE, if you can see at the moment, right, again we go through our system maximum drawdown, which is about minus 3.71, right. Our backtesting drawdown is about minus 4.04, which you can see over here. Let me just quickly erase those ones away, right, so you can see it more clearly. So you can see that, right, 3.71, 4.04, and our cash is actually, we actually missed a few trades which don't go in our favor in this particular strategy, right, and then we position size some wrongly, but anyway, so we are down minus 4.83, okay, so it is a bit off about 1.1% gap, right. So if the system, as you can see on the equity curve over here, let me see if I can, this will be a bit more easier. So there you go. So you can see that if you were to overlay them both on top of each other, let's see, yeah, so you can see there is a gap, right, that there's a gap. This stopped here and this one here. There's a bit of a gap, and the cash is further down. Always reference back your system when you want to think about whether your strategy is really working or not. Okay, so that's that one there. So we're not that far off from the system. That's what we call the gap in between, is what we call the profit gap. All right, most of the time for beginner traders, that can be usually against you because of your psychologically you're not in tune yet. This 1% is not very significant, so we're still monitoring that very closely. Okay, between the cash and the system. So that's the first thing you would look at in performance review, all your maximum drawdowns, all the different drawdowns of this. Okay, I've shown you for 50 and 20%, right? Now the other thing which I've written in the notes over here, now the next question would be that, oh, hang on a minute here, right? So you got all the maximum drawdowns and everything, but then the next question naturally will be, why are we getting such an equity curve, right? Why are we getting such an equity curve? Now on the 20% OE, what we are getting over here is, right, so we got this equity curve, and I use the system as the reference. So over here, what we got here, right, is this over here. Yeah, this was your last rally, and it bounced off a little bit and has come back down again. What absolutely we want usually on a best curve is the next rally that comes down not to take out the previous rallies, and it keeps going up and up, right? So that's what we want. What we do not want is something like this, right, where it takes out the last rally, comes back down again, and then finally gets there, even though it might get to the same destination of profits. But we do not want this one because it's more tougher, isn't it, to execute. I've explained that in the previous videos as well. So on the 20% OE, we can still say, you know what, it's still okay, we're still happy with this because we're still above the account balance, isn't it? We're still in profit, right? And the reason for that, and why we're more comfortable 20% OE, because it's got a 60-40 reliability from our back testing, and it's got 2.5 to 1 actual reward to risk ratio. Okay, so that's what it's got. So everything is good, and we're waiting for the big runners to come true and to bring this to the new equity high in this instance, right? So that's on the 20% OE. But the thing is, to get to this kind of stance, the downside about this strategy is got a reduced frequency, okay? Because you're taking very refined trades, right, to reduce the losses. And you can see over here, if I got the stats as well, I think I've got it for the 50% OE, but I'll show that to you later on too. So in instance, so here the downside of this is reduced frequency, but then on the other side, it's got very refined trades. So if you want to increase frequency, we increase the number of instruments, okay? But you don't stretch yourself too much, because then you won't be able to execute it correctly, and it will make mistakes, and then the system versus a cash profit gap will start to increase, okay? So we usually do it over 10 instruments. That's what we usually look at. So that's on the 20% OE. So far so good, and we are executing it as per the system. However, on the 50% OE, right, because it's got a more high frequency on this particular strategy, right, how we do the performance review is that what we are seeing at the moment, look at this, right, this is what we do not want, isn't it? We had a steady increase, we took a little bit of dip, and nice curve what we're having, but then it started doing this, right? So it took out the last valley, and it even went down below the account balance, which is not what we want. So when you take a look at this, and then you start to think, oh man, why is this happening, right? Because we've done on a real account where we've done all our track record performance and all of that on the FX book where we publish all the results. And then we're thinking, oh, why is this happening? It's a bit annoying, is this really working or not? And when you take a look at the reliability of this first, it's about 60 to 40, right? So that's all good then. Then you might be thinking, okay, why still? But the reward to risk ratio is about 1.2 to 1, right? Very near to 1 to 1. Actual, yeah, is what we're talking about. Now, so traders, and even though you might say, okay, but it still should be profitable, right? And why is it doing this? Now, this is where you need to understand why this is happening, is because you have to understand the second part of the analysis on why is the sequence of how your winners and losers come, right? Now, let's take a look into this into more detail. Now, your sequence of winners and losers, right? They might come in, let me just draw it here more clearer. In scenario 1, if we had 60 winners, all come right in the beginning, right? So if you got trade number 1, trade number 2, all winners, right? All winners all the way up to trade number 60. So all 60 winners come in the beginning. And then you have 40 losers then come, right? So what will happen? So in that instance, you will have a smooth line, right? 60 winners all coming through, and then the 40 losers. And that's it. That's where you will end off the curve with, okay? So in terms of 100 trades, so that would be what? I mean, if we just take a look at a ballpark figure, 72 minus 40, that's about 32% profit that you will end up with, yeah, on scenario 1, yeah. Now, however, in sequence of winners and losers, what happens if, right, the 60 winners don't come, right, all at the beginning, right? It becomes interspaced like this. So you get 30 winners first, then you get 25 losers, then you get 30 winners, right? And then after that, then you get 15 losers, okay? So in that instance, what then happens then? Your curve looks something like this, isn't it? 30, then 25, it loses it back, right? And then 30 winners again, takes out the last peak, maybe then 15 losers, then comes back. Still coming to the same point of 32% net profit, right? That is scenario 2, right? Now in scenario 3, let's say, what if I said this, right? Which is, you get equal distribution, and this can be very annoying when this happens. You get 20 winners, 20 losers, right? And then again you get 20 winners, right? So you get 20 losers, and then finally you get your 20 winners again. So you got 60 winners altogether, but then it came interspaced in between like this. So in scenario 3, your equity curve will start looking like this. So when 20 winners went up, 20 times 1.2, which is about what? 20, I think it's 20.4, right? And then after that, 24%, sorry. So 24%, and then after that, 20 losers, then it comes to plus 4. And then again, you had another 20, so 24 just takes out the last one, and then 20 losers again. So you see, it's about in the same area, you understand? And then finally, 20 winners come in, and then you end off with 32% net profit, right? So you see, traders between 1, 2, and 3, what would we all like? Of course, we all like number 1, isn't it? Still acceptable, maybe number 2, but number 3 is what we would definitely not like. Seesawing, not sure, lacks your confidence, everything. But the key point is what? They all get to the same point at the end, the net profit. Now, if you want to move 3 to 2 or to even 1, then it requires a lot of research. But sometimes you just can't do anything about it. It's just a sequence of how the winners and losers come. You just have to accept it, right? And this is what then was popularized for mathematical systems, this sequence of winners and losers, how they come, which we can't really control, really, isn't it, right? Unless I'll go through that in the last part, unless you look at other stats and everything. But how the sequence of winners and losers come is what we call, mathematical terms, you can run models on this. It's called a Monte Carlo system, right? Where the Monte Carlo, once you feed in all your data, it will start to rearrange it in all different ways of how your winners and losers can come and how the equity curve will look like, which is what I just drew for you here in 1, 2, and 3. Okay, so that's the second part. So this is why the equity curve is as such, right? And once you understand this, you're like, okay, that's fine. It is according to our testing and our system. That's fine. We will keep running it. All right. So that's the second part. Why is it doing as such, the equity curves on both the strategies? Okay. So that's that one there. The final thing, what we will look at as a professional in performance review, right? Now, maybe I can do it over here, and we can take a look at something over here right now on the 4-hour as well, and then maybe I can start drawing it on here. So what we got here, right, is what we are looking at. Now, the natural question then will be, okay, Tiru, you know, you're saying this, we want this, where it doesn't take out the last valley and all of that. Then if anything, if I don't want such a curve like this, how do I smoothen it? Is there any way then? So at that point, we have to look at two numbers, right? Which is what I was saying. Either increase the reliability of the strategy, maybe increase it to 80, 20, 80% winners, 20% losers, but still maintaining 1.2 to 1, it will become quite difficult. Or the other thing is reduce your average loss, okay? Right? So either one of them. What we found, if you want to stick with the original framework in which the volatility of the trade actually moves in, then the best thing is, without improving your reliability, reduce your average loss. And that's when I would say the first thing in reducing your average loss is go and study your big losses, okay? And in this system over here, our big losses usually equate to about 1%, right? Or to 200 pips stop loss that we got. So what you want to do when you study that, now here's the important thing, when you study your big losses, not just to see how you can eradicate them, because eradicating them is not the solution, because if you eradicate your big losses, you're eradicating also some of your big wins or your medium winners, right? So the real trick is to ask yourself, okay, when I study the big losses and the winners, especially the big losses, if I were to see any differences, and what we are really looking for is a distinct difference between a winner and a loser, right? Something that is distinct about the loser that doesn't appear in the winner. Now, once you got that, then bingo, then you can have your average loss reduced. So that's what your research needs to go into. Now, so that's what we actually then do. Once you got a distinction, then you set your rules. Okay, when this happens, when you get a setup like that, then I would reduce my risk on that, or I would not take the trade at all. So all those things you need to write down. So that's the kind of research that we did. Took some time back as we are executing on the previous version, right? And then we look at all the different versions over here. You see over here, all the different versions. Then we come back to here, gather them all together, right? And then you can see that version 12 over here was one of the best ones with 1.42. And once I can improve it from 1.18, 1.2 to 1.42, then what I'm really saying, traders, over here is that there's a more higher chance I can get a curve like that. A bit more easier on the psychology as well, is it not? So that's what we are really looking for, okay? So that's how we would really look at, and you saw that the version 12 that I showed you shows a 1.5 to 1. Now then we execute it in real time, and the usual thing again, we would monitor that in real time as well, okay? So those are the three things that we would look at. I've covered all the different perspectives on how we actually take a look at in terms of performance review, okay? So that's what we will be taking a look at. So let's just quick summary. So the first point of performance review is basically how does a professional look at or review his trading performance, and how you guys should be looking at. Look at the maximum drawdown number first, right? Second thing, then remember I talked about the three things in the maximum drawdown number as well. The second thing is that why such an equity curve, right? Why such an equity curve is happening? Is that still pertaining with the system? Why is it behaving in such a way? So all that you need to understand. And then the last thing is how, if any, to smoothen the curve or optimize your system, if there needs to be done anything or not. Okay, so these are the three things that you need to be looking at, and that's how we've got our equity curves over here. On the 20% OE and the 50% OE, which we are running on the Traders Challenge accounts. We keep you guys updated on how that goes. Remember, we are just like everyone else as well. We don't have a crystal ball to predict the markets, right? So we have to do it like professionals and review and monitor it. We don't have any guarantee that the system is going to work, but we have a systematic methodology where we are reviewing it, contemplating on it, and how we can are we still maintaining our edge towards it, realizing its sustainability, scalability, and reproducibility. All right, traders, I guess that's pretty much that on this live trading session video over here. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master. If you want to get notified every time we put a video up, especially on our live trading update videos, hit the subscribe button and turn on the bell notifications icon. This will get the YouTube algos to kick in, and for you to join us in our mission to spread the truth of trading further, so that traders like you can benefit from our videos to trade like a master, achieve consistent performance, and change lives.